Welcome to this space of calm and reflection. Tonight, we embark on a journey to quiet the mind and invite deep relaxation. If you find solace in these peaceful moments, please consider subscribing so you never miss a session. We'd also love to know where you're listening from tonight. Share your location in the comments below. The events of February 28, 2026, marked a significant escalation in geopolitical tensions. On this day, Operation Shield of Judah commenced, a coordinated military action undertaken by the United States and Israel. The operation's primary objective was to neutralize Iran's nuclear capabilities and dismantle key elements of its governmental and military infrastructure. Specific targets included the heavily fortified nuclear enrichment facilities at Fordow and Natanz, as well as the Isfahan nuclear complex. Concurrently, vital command and control centers were struck, including the Iranian Ministry of Defense, the Office of the Supreme Leader, and critical military installations. These strikes were strategically positioned across major Iranian cities: Tehran, Qom, Karaj, Kermanshah, and Tabriz. This decisive action followed the preceding Operation Midnight Hammer in June 2025, establishing a clear pattern of escalating engagement. Iran's response was immediate and forceful. The regime launched retaliatory missile and drone salvos, targeting Israel directly and U.S. military installations located in Bahrain. Reports confirmed intercepted Iranian projectiles over Qatar, underscoring the wide-reaching implications of this conflict. The immediate economic fallout was palpable. The Strait of Hormuz, a critical choke point for global energy transit, faces an unprecedented threat of disruption. This waterway is responsible for the daily passage of approximately 20 million barrels of oil and accounts for roughly 20% of global liquefied natural gas trade. In response to this heightened risk, crude oil prices surged past $72 per barrel. Goldman Sachs issued a stark warning, projecting prices could exceed $100 per barrel should the Strait of Hormuz be fully closed. Simultaneously, gold, a traditional safe haven asset, reached historic highs, trading above $5.200 per ounce. Financial markets reacted with volatility. U.S. stock markets experienced a significant downturn, with the S&P 500 index declining. The VIX, a measure of market volatility, rose above 20, signaling increased investor anxiety. In contrast, defense sector stocks demonstrated remarkable resilience, surging 17% year-to-date, reflecting anticipated increases in military spending. This unfolding geopolitical crisis presents a complex economic landscape, necessitating a strategic approach to wealth preservation. As we navigate these uncertain times, the geopolitical landscape in June 2025 was already a complex tapestry of simmering tensions. It was within this environment that Operation Midnight Hammer was launched. These strikes, targeting specific Iranian military assets, served as a critical, albeit often understated, precursor to the significant escalation that would follow. Understanding Midnight Hammer is essential to grasping the strategic buildup that culminated in Operation Shield of Judah in February 2026. The initial strikes in June 2025 were not isolated incidents. They represented a deliberate, calibrated move, signaling a hardening of resolve and a willingness to employ direct military action. While the full scope and impact of Midnight Hammer were not immediately apparent to the wider public, for intelligence agencies and defense planners, it was a clear indicator of evolving strategic objectives. The operation's success, or perceived success, in achieving its immediate goals likely emboldened proponents of a more assertive stance against Iran's nuclear program and regional activities. This period, therefore, is not merely a footnote. It is the foundational layer upon which the subsequent more extensive military operations were planned and executed. The echoes of Midnight Hammer resonate through the strategic decisions made in the months leading up to February 28, 2026. The strikes provided valuable intelligence, tested Iranian defenses, and, perhaps most importantly, established a precedent for direct engagement. This established a narrative of escalating pressure, a slow burn that would eventually ignite into a full-blown conflict. The limited nature of Midnight Hammer, in retrospect, served to demonstrate a measured approach, perhaps intended to gauge international reaction and Iranian responses before committing to a more significant intervention. The strategic calculus involved in such operations is always multifaceted, weighing potential gains against significant risks. The decision to proceed with further strikes in February 2026, therefore, was informed by the experiences and outcomes of Operation Midnight Hammer, underscoring its pivotal role in the unfolding events. On February 28, 2026, Iran initiated a direct retaliatory response to the preceding Operation Shield of Judah. This immediate phase of the conflict saw the launch of significant missile and drone salvos targeting Israel. Simultaneously, U.S. military installations in Bahrain came under attack, marking a critical escalation in the regional confrontation. These actions represented Iran's immediate, albeit asymmetrical, counteroffensive, demonstrating a capacity to project force beyond its borders. The scope of these salvos was substantial. Intelligence indicates hundreds of drones and ballistic missiles were deployed. The primary objective was to overwhelm Israeli air defenses and inflict damage on key Israeli infrastructure. While many of these projectiles were intercepted, a portion breached defenses, causing localized damage and underscoring the severity of Iran's retaliatory capability. In parallel, the U.S. base in Bahrain, a crucial hub for regional operations, experienced a direct drone and missile assault. This attack highlighted the interconnectedness of the conflict and the potential for spillover effects across the Persian Gulf. The successful interception of some Iranian projectiles over Qatar further illustrates the complex, multi-layered nature of these immediate responses and the defensive postures adopted by regional powers and their allies. These salvos, while a direct response, were strategically limited. They avoided targeting major population centers and focused primarily on military and strategic assets. This approach suggests a calculated effort to inflict damage and demonstrate resolve without triggering an all-out, uncontainable escalation at this initial stage. However, the sheer volume and nature of the attacks significantly increased tensions and the risk of miscalculation. The economic implications of these salvos were immediate and profound. The threat to maritime trade routes, particularly the Strait of Hormuz, intensified. This choke point, responsible for the transit of approximately 20 million barrels of oil daily and a fifth of global liquefied natural gas, became a focal point of concern. Fears of disruption sent crude oil prices surging, with benchmarks quickly surpassing $72 per barrel. Analysts at Goldman Sachs issued stark warnings, projecting prices could exceed $100 per barrel should the Strait face any prolonged closure. Concurrently, safe haven assets experienced a significant surge. Gold, a traditional hedge against geopolitical instability, reached record highs, trading above $5.200 per ounce. This flight to safety reflected a palpable sense of apprehension within global financial markets. The impact rippled through equity markets. U.S. stock indices, including the S&P 500, saw notable declines. The VIX, a measure of market volatility, rose above the 20-point threshold, indicating heightened uncertainty. Conversely, the defense sector demonstrated robust performance, with defense exchange-traded funds showing year-to-date gains of approximately 17%, signaling an anticipated increase in military spending. This segment of the market is poised to benefit from the evolving geopolitical landscape and the ongoing military operations. The regional reverberations of Operation Shield of Judah extend beyond the immediate conflict zones, drawing even ostensibly neutral nations into its orbit. On March 1, 2026, the skies over Qatar became a stark illustration of this widening impact. Iranian retaliatory missiles, launched in the early hours of the morning, were detected and intercepted by Qatari air defense systems. This incident, occurring just hours after the initial U.S.-Israel strikes on Iranian soil, underscores a critical reality. No nation in the immediate vicinity is truly insulated from the unfolding events. Qatar, a nation that has historically sought to maintain a balanced foreign policy and often plays a mediating role in regional disputes, found itself directly confronting the kinetic effects of the hostilities. The interception signifies not an act of aggression by Qatar, but a defensive measure against stray or intended payloads traversing its sovereign airspace. The implications are significant. For Qatar, it represents a direct challenge to its security and its carefully cultivated neutrality. The presence of intercepted Iranian missiles over its territory raises questions about potential collateral damage and the broader risk of the conflict spilling over its borders. This event highlights the interconnectedness of the region and the difficulty of remaining detached when major powers engage in direct military confrontation. The geographical reach of this conflict is rapidly expanding. What began with targeted strikes on Iranian nuclear and defense infrastructure is now manifesting as a tangible threat to nations with no direct stake in the original U.S.-Iran tensions. The interception over Qatar is a concrete data point demonstrating that the fallout from Operation Shield of Judah is not confined to Iran, Israel, or U.S. bases in the immediate vicinity. It is a clear signal that regional stability is fragile and that the potential for escalation carries with it a broad spectrum of risks for all involved. This incident serves as a potent reminder that in modern warfare the lines between combatant and non-combatant, and between conflict zones and neutral territories can become blurred with alarming speed. The economic and geopolitical ramifications of such events are profound, affecting trade routes, regional alliances, and global supply chains with an immediacy that demands careful analysis and strategic foresight. The Strait of Hormuz stands as a critical nexus in global energy transport. Every day, an estimated 20 million barrels of crude oil traverse its narrow waters. This volume represents a substantial portion of global oil supply, a fact underscored by the daily reliance on this waterway. Beyond crude oil, the strait is equally vital for liquefied natural gas, accounting for approximately 20% of the world's total LNG trade. This dual role as a conduit for both oil and gas makes any disruption to its flow a matter of profound global economic consequence. The recent military operations, commencing with Operation Midnight Hammer in June 2025 and escalating with Operation Shield of Judah on February 28, 2026, directly impact this vital choke point. The targeted strikes against Iran's nuclear and defense infrastructure, alongside retaliatory actions, create a volatile environment. The potential for the Strait of Hormuz to become a theater of conflict or to face operational impediments looms large. The immediate market reaction reflects this heightened risk. Crude oil prices have already surpassed $72 per barrel, with projections from analysts like Goldman Sachs suggesting a potential surge to over $100 per barrel should the strait be closed. This volatility extends to other safe haven assets, with gold reaching record highs above $5.200 per ounce. Financial markets are responding, with the S&P 500 experiencing declines and the VIX index indicating increased market uncertainty. Conversely, the defense sector has seen significant gains, rising 17% year-to-date, reflecting anticipated increases in military spending. Understanding the potential economic repercussions requires examining several plausible scenarios. The first involves a limited series of strikes, followed by a swift de-escalation, allowing energy flows to stabilize. A second, more prolonged scenario could see an extended air campaign, potentially leading to more significant and sustained disruptions. The third scenario envisions a broader regional conflict, drawing in proxy forces and further destabilizing the Middle East. Fourth, the possibility of regime change within Iran presents another complex variable. Finally, a negotiated settlement, potentially facilitated by Omani mediation, offers a path towards de-escalation and the restoration of stability. The impact of these events reverberates across the globe. The Gulf states face a delicate balancing act. Saudi Arabia and the UAE have notably declined to provide direct assistance to the United States. Qatar, meanwhile, has found itself intercepting Iranian missiles, highlighting its direct exposure. Iraq has closed its airspace, adding another layer of logistical complexity. Asia, a primary destination for oil transiting the Strait, is particularly vulnerable. China, India, Japan, and South Korea collectively depend on 69% of the oil that passes through Hormuz. Any interruption to this supply chain would have profound implications for their economies. Europe faces its own set of challenges, with potential disruptions to LNG supplies threatening to exacerbate inflationary pressures and increase the risk of stagflation. Emerging markets, often more susceptible to external shocks, are bracing for significant inflationary headwinds. In this environment of heightened geopolitical uncertainty, strategic financial planning is paramount. Gold has historically served as a primary safe haven asset, demonstrating median gains of 6% in the aftermath of geopolitical crises. U.S. Treasuries offer a degree of stability amidst market turbulence. Exposure to the energy sector, given the typical rally in crude oil prices following such events, presents another avenue for consideration. Defense sector exchange-traded funds are also positioned to benefit from increased global military expenditure. Fundamental principles of wealth preservation, including avoiding panic selling, employing dollar-cost averaging, and ensuring geographic diversification of assets, become increasingly important. The domestic political landscape within the United States is also a significant factor, with debates surrounding the War Powers Resolution and the approaching 2026 midterm elections adding further complexity to the unfolding situation. The specter of closure over the Strait of Hormuz looms large, a critical choke point for global energy markets. Through this vital waterway, an estimated 20 million barrels of oil traverse daily, alongside 20% of the world's liquefied natural gas trade. The implications of any disruption are immediate and severe. Goldman Sachs, a leading financial institution, has projected that a complete closure of the strait could send oil prices soaring past $100 per barrel. This forecast underscores the tangible financial risks inherent in the current geopolitical climate. The surge in oil prices beyond $72 per barrel following the initial escalation serves as a stark indicator of market sensitivity. Simultaneously, gold has reached record highs, exceeding $5.200 per ounce, reflecting its traditional role as a safe haven asset during times of uncertainty. In the United States, financial markets are already responding. The S&P 500 has seen declines, and the VIX, a measure of market volatility, has climbed above 20. Conversely, the defense sector has demonstrated remarkable resilience, with defense stocks experiencing a year-to-date surge of 17%. This performance highlights the significant capital flows shifting towards industries perceived as beneficiaries of increased global military spending. The potential for sustained conflict introduces a spectrum of economic consequences. The immediate financial risks are evident in fluctuating commodity prices and market volatility. However, a more prolonged or expanded conflict could trigger cascading effects across various sectors and regions. The energy sector in particular is poised for significant shifts. Historically, crude oil prices have often rallied by an average of 18% in the aftermath of geopolitical crises of this nature. This suggests that while volatility is a given, specific sectors may experience substantial growth. For investors, this period demands a strategic approach. The traditional safe haven asset, gold, has historically shown median gains of around 6% following geopolitical crises, offering a degree of protection against market downturns. U.S. Treasuries, while offering stability, present a different risk-reward profile in an inflationary environment. Exposure to the energy sector, particularly in light of potential supply constraints, warrants careful consideration. Furthermore, the projected increase in global defense spending creates a compelling case for investments in defense exchange-traded funds. The economic fallout extends far beyond the immediate financial markets. Asia, heavily reliant on oil flows through the Strait of Hormuz, faces significant challenges. China, India, Japan, and South Korea collectively depend on 69% of the oil passing through this waterway. Any disruption poses a direct threat to their energy security and economic stability. Europe, too, is vulnerable, particularly to disruptions in LNG supply, which could exacerbate existing inflationary pressures and lead to stagflation. Emerging markets are also exposed to the risk of inflationary shocks, potentially destabilizing their economies. Navigating these complex economic waters requires a clear understanding of the interconnectedness of global markets and a disciplined approach to wealth management. The focus remains on informed decision-making, leveraging data and expert analysis to mitigate risks and identify potential opportunities amidst uncertainty. The market's immediate response to Operation Shield of Judah was swift and decisive, particularly in its valuation of gold. On February 28, 2026, as news of the joint U.S.-Israeli strikes against Iran's nuclear facilities and military infrastructure broke, gold prices surged to unprecedented heights. The precious metal breached the $5.200 per ounce mark, establishing a new all-time record. This dramatic ascent underscores gold's enduring role as the preeminent safe haven asset during periods of significant geopolitical instability. The escalation follows a pattern of rising tensions, with Operation Shield of Judah building upon the earlier Operation Midnight Hammer strikes in June 2025. Iran's retaliatory actions, including missile and drone salvos targeting Israel and U.S. bases in Bahrain, with interceptions occurring over Qatar, have heightened concerns over regional stability. The critical chokepoint of the Strait of Hormuz, through which an estimated 20 million barrels of oil daily and 20% of global liquefied natural gas trade transit, now faces the distinct possibility of disruption. This potential blockade has sent shockwaves through energy markets. Crude oil prices have already surpassed $72 per barrel, and Goldman Sachs has issued a stark warning, projecting prices could exceed $100 per barrel should the Strait's passage be impeded. Against this backdrop of energy market volatility and geopolitical uncertainty, gold's performance highlights a flight to tangible assets perceived as secure stores of value. The surge above $5.200 per ounce is not merely a price fluctuation. It is a clear market signal of apprehension regarding the unfolding events and their potential economic ramifications. U.S. equity markets have reacted with significant declines. The S&P 500 has experienced a notable drop, and the VIX index, a measure of market volatility, has risen above 20, indicating increased investor anxiety. Conversely, the defense sector has seen substantial gains, with defense stocks collectively appreciating 17% year-to-date, reflecting anticipated increases in military spending. This divergence in market performance illustrates the immediate economic consequences of active military operations and the re-evaluation of asset classes by investors seeking to navigate this complex environment. The ascendance of gold to record levels above $5.200 per ounce serves as a critical data point, demonstrating the market's perception of risk and its preference for traditional safe havens in times of escalating geopolitical crisis. The geopolitical landscape has fundamentally shifted following Operation Shield of Judah. Initiated on February 28, 2026, the joint U.S.-Israeli military action targeted critical Iranian nuclear facilities and military infrastructure. This decisive engagement, a continuation of the June 2025 Operation Midnight Hammer, has rippled through global markets, revealing a heightened state of economic vulnerability. The immediate aftermath saw significant pressure on U.S. equity markets. The S&P 500 experienced a notable downturn, reflecting investor apprehension. Simultaneously, the VIX index, a key measure of market volatility, climbed above the 20-point threshold. This surge above 20 indicates a palpable increase in uncertainty and a heightened expectation of price swings. Such conditions are consistent with periods of significant geopolitical stress, where the potential for further escalation or unforeseen developments casts a shadow over investment portfolios. The catalyst for this market reaction is the ongoing conflict and its potential to disrupt vital global trade routes. The Strait of Hormuz, a critical choke point through which approximately 20 million barrels of oil and 20% of global liquefied natural gas trade pass daily, faces imminent threat. Any sustained disruption here would inevitably lead to a significant surge in energy prices. Indeed, crude oil has already surpassed $72 per barrel, with analysts at Goldman Sachs issuing stark warnings of prices exceeding $100 if the strait were to be closed. This price volatility in energy markets directly impacts inflation and consumer spending worldwide. Beyond oil, the precious metals market has reacted decisively. Gold, a traditional safe haven asset, has reached record highs, trading above $5.200 per ounce. This price action underscores a global flight to safety as investors seek to preserve capital amidst escalating geopolitical tensions. The impact is not confined to commodities. Defense stocks have shown remarkable resilience, surging 17% year-to-date. This performance highlights the anticipated increase in military spending and the direct beneficiaries of prolonged or intensified conflict. The current situation presents a complex array of potential future scenarios. These range from a rapid de-escalation following limited strikes to an extended air campaign or a broader regional war drawing in proxy forces. The possibility of regime change in Iran or a negotiated settlement brokered through diplomatic channels remain significant variables. Each scenario carries distinct implications for global economic stability and financial markets. The ramifications extend across continents. Gulf states, including Saudi Arabia and the UAE, have adopted positions of non-assistance, while Qatar has intercepted Iranian missile fire. Iraq's closure of its airspace further complicates regional logistics and trade. Asia, heavily reliant on oil flowing through the Strait of Hormuz, with China, India, Japan, and South Korea collectively depending on 69% of these flows, faces direct energy supply risks. Europe, already grappling with inflationary pressures, now confronts the added threat of LNG supply disruption, heightening the risk of stagflation. Emerging markets, often more vulnerable to external shocks, are particularly exposed to inflationary pressures and capital flight. Navigating these turbulent waters requires a strategic approach to wealth preservation. Gold stands out as a primary safe haven, historically demonstrating median gains of 6% following geopolitical crises. U.S. Treasuries offer a degree of stability amidst equity market volatility. The energy sector, despite its inherent price fluctuations, typically rallies post-geopolitical events, with crude oil prices showing an average increase of 18% after such incidents. Furthermore, defense sector exchange-traded funds are poised to benefit from a sustained increase in global military expenditure. Crucially, maintaining a disciplined investment approach is the global economic landscape is undergoing a profound transformation, catalyzed by escalating geopolitical tensions. As of early 2026, the defense sector is demonstrating remarkable resilience and growth, with defense stocks having surged 17% year-to-date. This performance is directly linked to the ongoing military operations, particularly the recent strikes under Operation Shield of Judah, launched on February 28, 2026. These strikes, a joint effort by the United States and Israel, targeted critical Iranian infrastructure, including nuclear facilities at Fordow, Natanz, and Isfahan, alongside key government and military installations across multiple cities. This action follows the earlier Operation Midnight Hammer strikes in June 2025, indicating a sustained period of heightened conflict. Iran's response has been swift and significant, employing missile and drone attacks against Israel and U.S. bases in Bahrain. The implications for global trade are substantial, with particular concerns surrounding the Strait of Hormuz. This vital waterway, responsible for the daily transit of 20 million barrels of oil and 20% of global liquefied natural gas trade, faces the threat of disruption. In anticipation of such events, oil prices have already surpassed $72 per barrel, with Goldman Sachs projecting prices exceeding $100 if the Strait's flow is halted. Concurrently, gold has reached record highs, trading above $5.200 per ounce, underscoring its traditional role as a safe haven asset during times of uncertainty. U.S. equity markets have reacted with volatility. The S&P 500 has experienced declines, and the VIX index, a measure of market volatility, has risen above 20. Against this backdrop of broader market stress, the defense industry stands out. The significant gains in defense stocks reflect an anticipated increase in military spending and a sustained demand for security solutions amidst a complex international security environment. This surge is not merely a short-term reaction but appears to be driven by a recalibration of global defense priorities. The current situation presents a spectrum of potential outcomes, ranging from a swift de-escalation following limited strikes to a prolonged air campaign, or even a wider regional conflict involving proxy forces. The possibility of regime change or a negotiated settlement through diplomatic channels, such as the ongoing Omani mediation efforts, also remains. The impact of these events extends across various regions. Gulf states like Saudi Arabia and the UAE have signaled a reluctance to provide direct assistance to the U.S., while Qatar has engaged in missile interception, highlighting a complex regional alignment. Iraq's decision to close its airspace further illustrates the ripple effects. Asian economies, including China, India, Japan, and South Korea, are particularly vulnerable, as they collectively rely on 69% of the oil flowing through the Strait of Hormuz. European nations face the dual threat of LNG supply disruptions and the risk of stagflation. Emerging markets are confronting inflationary shocks that could destabilize their economies. In navigating these turbulent financial waters, strategic asset allocation becomes paramount. Gold has historically demonstrated median gains of 6% following geopolitical crises, positioning it as a primary safe haven asset. U.S. Treasuries offer a degree of stability in volatile markets. The energy sector, with crude oil typically rallying approximately 18% after such events, presents another avenue for consideration. Furthermore, defense exchange-traded funds, or ETFs, are poised to benefit from an anticipated supercycle in military spending. Key principles for wealth preservation include avoiding panic selling, maintaining a strategy of dollar-cost averaging, and ensuring geographic diversification of assets. Domestically, the unfolding events carry significant political weight, including debates surrounding the War Powers Resolution and the approaching 2026 midterm elections, which will undoubtedly be influenced by the nation's engagement in international conflicts and their economic consequences. The unfolding geopolitical landscape presents a critical juncture for global markets, with significant implications for investment portfolios. Operation Shield of Judah, launched on February 28, 2026, marks a substantial escalation in regional tensions, targeting key Iranian military and nuclear infrastructure. This operation, following the preceding Operation Midnight Hammer in June 2025, immediately impacted global energy markets and financial instruments. The Strait of Hormuz, a vital artery for global commerce, faces unprecedented risk. Carrying approximately 20 million barrels of oil daily and representing 20% of global liquefied natural gas trade, its potential closure triggers immediate economic consequences. This threat has already propelled oil prices beyond $72 per barrel, with projections from Goldman Sachs warning of prices exceeding $100 should the strait be significantly disrupted. Concurrently, gold, a traditional safe haven asset, has reached record highs surpassing $5.200 per ounce, reflecting investor concerns about stability. U.S. equity markets have reacted with volatility. The S&P 500 has experienced a notable decline, while the VIX, a measure of market fear, has risen above 20. In stark contrast, the defense sector has demonstrated remarkable resilience and growth, with defense stocks appreciating by 17% year-to-date. This performance underscores a significant investment opportunity. For investors seeking to navigate these turbulent times and capitalize on the evolving defense landscape, exchange-traded funds, or ETFs, offer a strategic avenue. These diversified funds provide exposure to a basket of defense-related companies, mitigating the risks associated with individual stock selection. As global military spending intensifies in response to ongoing geopolitical events, defense ETFs are poised to benefit from this sustained upswing. Consider the historical precedent. Following periods of heightened geopolitical instability, the defense sector has consistently outperformed. The current operational tempo and the projected long-term increase in defense budgets globally create a compelling case for strategic allocation within this industry. The consolidation of defense contractors, coupled with advancements in military technology, further enhances the attractiveness of this sector. Analyses of the current situation suggest several potential scenarios, each with its own set of economic ramifications. A limited engagement followed by de-escalation, an extended air campaign, or a broader regional conflict involving proxy forces, all carry distinct market implications. The potential for regime change in Iran or a negotiated settlement through diplomatic channels such as Omani mediation also influences market sentiment and investment strategies. The impact extends beyond immediate financial markets. Gulf states, including Saudi Arabia and the UAE, have adopted cautious stances, while Qatar's role in intercepting Iranian missiles highlights regional complexities. Iraq's closure of its airspace further illustrates the cascading effects of the conflict. Asia, heavily reliant on oil flows through the Strait of Hormuz, faces significant economic headwinds, as do European economies grappling with potential LNG supply disruptions and stagflationary pressures. Emerging markets are particularly vulnerable to inflationary shocks. In this environment, wealth protection strategies become paramount. Gold's historical performance, with median gains of 6% after geopolitical crises, positions it as a primary safe haven. U.S. Treasuries offer stability amidst market turmoil. The energy sector, with crude oil typically rallying 18% following such events, presents another area of potential upside. Defense ETFs, as previously discussed, offer exposure to a sector experiencing a secular growth trend. Adherence to fundamental investment principles is crucial. Avoiding panic selling, implementing dollar-cost averaging, and maintaining geographic diversification are essential for preserving capital and achieving long-term financial objectives. The domestic political landscape in the United States, including debates surrounding the War Powers Resolution and the approaching 2026 midterm elections, adds another layer of complexity to the economic outlook. Calm, measured narration begins. Operation Shield of Judah, launched on February 28, 2026, represents a significant escalation in the ongoing conflict with Iran. The immediate question facing global markets and strategists alike is the likelihood of a swift de-escalation, confining the conflict to the strikes conducted. Several factors would contribute to such a scenario. The primary driver for de-escalation would be a mutual understanding, perhaps tacit, that the immediate objectives have been met, and further engagement carries unacceptable risks. For the United States and Israel, the targeted strikes aimed at disrupting Iran's nuclear capabilities and military infrastructure at locations like Fordo, Natanz, Isfahan, and key defense sites across Tehran and other major cities could be deemed sufficient to achieve a temporary setback for Iran's strategic ambitions. Iran's retaliatory actions, including missile and drone salvos against Israel and U.S. bases in Bahrain, while demonstrating resolve, also carry inherent limitations. The interception of these projectiles over Qatar highlights the defensive capabilities in place, potentially discouraging a full-scale, uncontained response from Tehran. If Iran perceives its retaliatory capacity to have been demonstrated without triggering a devastating escalation, it might choose to pause. Furthermore, the global economic ramifications are a powerful deterrent. The Strait of Hormuz, a critical artery for 20 million barrels of oil daily and 20% of global LNG trade, remains a potent point of vulnerability. The immediate surge in oil prices past $72 a barrel, coupled with warnings from Goldman Sachs of potential $100 oil if the strait closes, underscores the precipitous economic consequences of prolonged conflict. Similarly, gold's record ascent above $5.200 per ounce reflects a flight to safety that no nation wishes to prolong unnecessarily. The measured response from key regional players also plays a crucial role. The refusal of Saudi Arabia and the UAE to directly assist U.S. operations, while Qatar actively intercepted Iranian missiles, suggests a complex regional calculus that could favor containment. Iraq's closure of its airspace, while disruptive, also indicates a reluctance to be drawn fully into the conflict. This fragmentation of regional support for either side could limit the scope of any potential expansion. The financial markets, while volatile, are also signaling a desire for stability. The S&P 500's decline, alongside a VIX index above 20, indicates investor apprehension, but the simultaneous surge of defense stocks by 17% year-to-date points to a sector poised to benefit from sustained, albeit limited, geopolitical tension. This dynamic can create an environment where a controlled conclusion is seen as more economically advantageous than an uncontrolled spiral. Crucially, the international diplomatic landscape, even amidst heightened tensions, remains a factor. The potential for mediation, perhaps through established channels like Omani diplomacy, could offer a pathway to de-escalation. The memory of Operation Midnight Hammer in June 2025, which preceded these strikes, serves as a reminder of the cyclical nature of these confrontations and the potential for periods of intense activity followed by a return to a tense equilibrium. In essence, a rapid de-escalation hinges on the perception that immediate strategic objectives have been achieved, that the economic costs of further engagement are too high for all parties, and that regional and international actors are not inclined to broaden the conflict. The current situation is fluid, but these factors represent the most significant drivers toward a contained outcome for Operation Shield of Judah. The immediate aftermath of Operation Shield of Judah presents a critical juncture for global markets. The question is whether a swift de-escalation will usher in a period of renewed stability, or if the underlying geopolitical tensions, now demonstrably volatile, will cast a long shadow of uncertainty over economic activity. The initial market reaction, characterized by a surge in oil prices to over $72 per barrel and gold reaching record highs above $5.200 per ounce, reflects a palpable fear of supply chain disruption. The Strait of Hormuz, a vital artery for 20 million barrels of oil daily and a significant portion of global LNG trade, remains a focal point of this anxiety. Goldman Sachs' warning of potential prices exceeding $100 per barrel in the event of a closure underscores the fragility of the current energy landscape. U.S. equity markets have responded with a notable downturn, evidenced by the S&P 500's decline and the VIX, a measure of market volatility, climbing above 20. Conversely, the defense sector has shown resilience, with defense stocks appreciating by an average of 17% year-to-date. This divergence highlights a bifurcated market sentiment, with some sectors bracing for sustained conflict and others anticipating a return to a more predictable environment. This scenario of limited strikes, followed by de-escalation, while offering a path toward stability, is not without its complexities. The swiftness and sincerity of any de-escalation efforts will be paramount. A rapid return to diplomatic channels, perhaps facilitated by mediators like Oman, could see markets begin to price in a resolution. This would likely involve a gradual easing of oil prices from their immediate peaks, though a complete return to pre-strike levels would depend on the perceived durability of the peace. However, the persistence of underlying tensions is a significant concern. The memory of Operation Midnight Hammer in June 2025 and the subsequent retaliatory actions suggests that the current conflict is not an isolated incident but part of a broader, escalating dynamic. Even if immediate hostilities cease, the increased risk premium associated with the region, particularly concerning energy supplies, may linger. This could translate into structurally higher energy costs and a sustained increase in geopolitical risk premiums across various asset classes. The impact on Gulf states adds another layer of complexity. Saudi Arabia and the UAE's refusal to assist the U.S., Qatar's role in intercepting missiles, and Iraq's closure of its airspace all point to a recalibration of regional alliances and priorities. This fragmentation could hinder coordinated efforts towards de-escalation and, conversely, embolden actors seeking to exploit the instability. For Asia, the implications are particularly acute. China, India, Japan, and South Korea, collectively reliant on 69% of the oil flowing through the Strait of Hormuz, face significant economic headwinds. Any sustained disruption would exacerbate existing inflationary pressures and could slow their growth trajectories. In Europe, the risk of LNG supply disruption, coupled with existing energy market volatility, heightens the threat of stagflation. Emerging markets, already vulnerable to external shocks, are likely to bear the brunt of inflationary pressures stemming from higher energy and commodity prices. Therefore, while a rapid return to stability is a possibility, the potential for lingering uncertainty demands a measured and strategic approach to financial planning. The market's immediate reaction is a clear signal of the heightened risks. The degree to which these risks are priced in, and whether they abate or intensify, will be the defining narrative for the coming months. The dawn of February 28, 2026, marked a significant escalation in regional tensions. Operation Shield of Judah, a joint endeavor by the United States and Israel, commenced with a series of targeted strikes against Iran. The objectives were clear: to cripple Iran's nascent nuclear program at key facilities like Fordow, Natanz, and Isfahan, and to degrade its military and governmental command structures. Locations struck included the Iranian Ministry of Defense, the Office of the Supreme Leader, and military installations scattered across Tehran, Qom, Karaj, Kermanshah, and Tabriz. This operation followed the precedent set by the June 2025 Operation Midnight Hammer, indicating a sustained strategic approach. Iran's response was immediate and forceful. Missile and drone salvos targeted Israel directly and also struck U.S. bases in Bahrain. The skies over Qatar became a theater of interception as Iranian projectiles were engaged. The immediate concern gravitated towards the Strait of Hormuz, a vital artery for global energy trade. An estimated 20 million barrels of oil and 20% of the world's liquefied natural gas transit this narrow waterway daily. The specter of its closure sent immediate shockwaves through financial markets. Crude oil prices surged past $72 a barrel, with projections from Goldman Sachs warning of potential prices exceeding $100 if the strait became impassable. Concurrently, gold, a traditional safe haven, soared to record highs, surpassing $5.200 per ounce. In the United States, equity markets reflected the heightened uncertainty. The S&P 500 experienced a downturn, and the VIX, a measure of market volatility, climbed above 20. Conversely, defense sector stocks demonstrated robust performance, registering a notable 17% increase year-to-date. This unfolding conflict presents several plausible trajectories. One scenario anticipates limited strikes, followed by a period of de-escalation. However, the current operational tempo suggests the possibility of an extended air campaign, designed to exert prolonged pressure on Iran's capabilities and resolve. Beyond aerial operations, there lies the risk of wider regional escalation, potentially drawing in proxy forces such as the Houthi movement in Yemen and various Iraqi militia groups. Further possibilities include a concerted effort towards regime change within Iran, or a negotiated settlement, potentially facilitated by Omani mediation. The ramifications extend across the geopolitical landscape. Gulf states find themselves in delicate positions. Saudi Arabia and the United Arab Emirates have indicated a refusal to provide direct assistance to the U.S.-led operations. Qatar, however, has been directly involved in intercepting Iranian missiles, and Iraq has closed its airspace, complicating transit routes. Asia, heavily reliant on energy flows from the Persian Gulf, faces significant challenges. China, India, Japan, and South Korea collectively depend on 69% of the oil passing through the Strait of Hormuz. Europe, meanwhile, confronts the dual threat of LNG supply disruptions and the specter of stagflation. Emerging markets are particularly vulnerable to inflationary shocks, which can destabilize already fragile economies. Navigating these turbulent economic waters requires a strategic approach to wealth preservation. Gold's historical performance suggests its efficacy as a primary safe haven asset, exhibiting median gains of 6% following geopolitical crises. U.S. Treasuries offer a degree of stability amidst market volatility. Exposure to the energy sector warrants consideration, as crude oil prices typically rally substantially in the aftermath of such events, often by 18%. Defense sector exchange-traded funds are also positioned to benefit from a sustained increase in military spending. Fundamental principles of financial resilience remain paramount, avoiding panic-driven selling, employing dollar-cost averaging for consistent investment, and maintaining geographic diversification across portfolios. Domestically, the conflict intersects with the ongoing debate surrounding the war powers resolution and the approaching 2026 midterm elections, adding a layer of political complexity to the economic outlook. The economic repercussions of a protracted air campaign such as Operation Shield of Judah extend far beyond immediate market reactions. Sustained military operations invariably lead to prolonged supply chain disruptions, a significant increase in energy costs, and a pervasive atmosphere of market uncertainty that can linger for months if not years. Consider the energy markets. The Strait of Hormuz, a critical choke point through which approximately 20 million barrels of oil and 20% of global liquefied natural gas trade transit daily, faces the constant threat of disruption. Even the potential for closure sent oil prices surging past $72 per barrel in the immediate aftermath. Financial institutions like Goldman Sachs have projected prices exceeding $100 per barrel should the strait be fully closed, a scenario that would send shockwaves through global inflation and trade. This price volatility directly impacts transportation, manufacturing, and consumer spending across the globe. The impact on financial assets is equally pronounced. Gold, traditionally a safe haven during geopolitical instability, has already surged to record levels above $5.200 per ounce. This demonstrates investor flight to tangible assets, perceived as less susceptible to the vagaries of conflict. Conversely, broader equity markets, such as the S&P 500, have experienced significant declines, with the VIX, a measure of market volatility, climbing above 20. This indicates heightened investor anxiety and a recalibration of risk premiums. In stark contrast, defense stocks have seen a robust rally, gaining 17% year-to-date, reflecting anticipated increases in military spending and demand for related technologies and services. The ripple effects are felt acutely in Asia, a continent heavily reliant on Middle Eastern oil flows. China, India, Japan, and South Korea collectively depend on 69% of the oil that passes through the Strait of Hormuz. Any sustained disruption there translates directly into energy scarcity and inflationary pressures for these major economic powerhouses. Europe, too, faces significant challenges, particularly concerning its liquefied natural gas supply. Disruptions to LNG shipments from the Persian Gulf exacerbate existing energy vulnerabilities and increase the risk of stagflation, a damaging combination of high inflation and stagnant economic growth. Emerging markets are particularly susceptible, often lacking the economic buffers to absorb the inflationary shocks and currency devaluations that accompany prolonged geopolitical crises. The economic strain is not confined to international trade and commodity prices. Government expenditures are inevitably redirected towards military readiness and operations, potentially diverting funds from domestic infrastructure projects, social programs, or technological innovation. This shift in fiscal priorities can have long-term consequences for economic development and growth. Furthermore, the uncertainty surrounding the duration and scope of military engagements discourages long-term investment. Businesses become hesitant to commit capital to new ventures or expansions when the future geopolitical landscape remains unclear, leading to a slowdown in job creation and economic dynamism. The economic calculus of Operation Shield of Judah, therefore, is multifaceted and demands careful consideration. It is a complex interplay of disrupted supply chains, volatile energy markets, shifting investor sentiment, and the fundamental reallocation of global resources. Understanding these dynamics is crucial for navigating the evolving economic environment. The conflict, initiated by Operation Shield of Judah on February 28, 2026, carries a significant risk of cascading into a broader regional conflagration. This escalation pathway often involves the activation of proxy forces, groups that can extend a state's reach and influence without direct attribution or full commitment of regular forces. In this scenario, the focus sharpens on the Houthi movement in Yemen and various Iraqi Shia militias. The Houthis, already engaged in a protracted conflict and demonstrating a capacity for sophisticated drone and missile attacks, represent a potent force capable of disrupting maritime trade and regional stability. Their historical alignment and demonstrated willingness to target perceived adversaries of Iran make them a likely candidate for activation should Tehran seek to retaliate or exert pressure through asymmetric means. The strategic location of Yemen, bordering the Bab el-Mandeb Strait, a critical choke point for Red Sea shipping, amplifies the potential impact of Houthi actions. Any significant disruption here, in addition to the already precarious Strait of Hormuz, would further constrict global energy flows and exacerbate economic pressures. Similarly, a network of Iraqi Shia militias, some with direct ties to Iran's Quds force, presents another vector for escalation. These groups have previously demonstrated capabilities in targeting U.S. interests and infrastructure within Iraq and Syria. Their potential activation could manifest as attacks on remaining U.S. military installations in Iraq, or as a means to pressure the Iraqi government, which has sought to navigate a delicate balance between its relationship with its powerful neighbor and its security cooperation with the United States. The closure of Iraqi airspace following the initial strikes underscores the complex regional dynamics at play and the potential for these proxies to exploit existing vulnerabilities. The activation of these proxies would not be a spontaneous event. It would likely be a coordinated, albeit deniable, response by Iran. Tehran possesses established channels for communication, logistical support, and strategic direction of these groups. Intelligence assessments suggest that Iranian command structures maintain a high degree of influence, allowing for the strategic deployment of these forces to achieve specific objectives, whether it be to divert attention, inflict economic damage, or demonstrate resolve. The decision to activate these proxies would be a calculated one, weighed against the potential for further Iranian isolation and increased international sanctions. However, the perceived need to respond to strikes on its core infrastructure and leadership could override such considerations, triggering a dangerous domino effect across the Middle East. The precise timing and nature of such activations would depend on Iran's strategic calculus and its assessment of the evolving battlefield dynamics. The launch of Operation Shield of Judah on February 28, 2026, marks a significant escalation in the Middle East, following the initial strikes of Operation Midnight Hammer in June 2025. These joint U.S. and Israeli operations target critical Iranian nuclear facilities at Fordow, Natanz, and Isfahan, alongside key governmental and military installations across Tehran and other major cities. Iran's immediate response involves missile and drone barrages directed at Israel and U.S. military positions in Bahrain, with interceptions reported over Qatar. The flashpoint of the Strait of Hormuz, a vital artery for global energy, now stands at the precipice of disruption. This waterway is responsible for the transit of approximately 20 million barrels of oil daily, in addition to 20% of the world's liquefied natural gas trade. The potential for a closure or severe impediment to this flow has triggered immediate market reactions. Crude oil prices have already surpassed $72 per barrel, with Goldman Sachs forecasting a potential rise to over $100 per barrel should the strait become inaccessible. Concurrently, gold has reached record highs, trading above $5.200 per ounce, reflecting its traditional role as a safe haven asset amid geopolitical turmoil. U.S. equity markets have experienced a downturn, with the S&P 500 registering declines and the VIX volatility index climbing above 20. Conversely, defense sector stocks have seen a substantial surge, up 17% year-to-date, indicating anticipation of increased military spending. The implications of this conflict extend far beyond immediate military engagements, presenting a spectrum of potential geopolitical scenarios. The first scenario anticipates limited strikes, followed by a swift de-escalation, a hopeful but uncertain outcome. A second, more protracted possibility involves an extended air campaign, prolonging the period of instability. The gravest concern, however, is the potential for escalation into a wider regional war. This could draw in non-state actors such as the Houthi forces in Yemen and various Iraqi militia groups, amplifying the conflict's reach and complexity. Further possibilities include a concerted effort towards regime change in Iran or a negotiated settlement, potentially facilitated by Omani mediation. The impact on neighboring Gulf states is profound. Saudi Arabia and the United Arab Emirates have indicated a refusal to provide direct assistance to U.S. operations. Qatar, however, has been involved in intercepting Iranian missiles, while Iraq has closed its airspace, highlighting the fractured regional response. Asia faces significant economic repercussions, as China, India, Japan, and South Korea collectively rely on the Strait of Hormuz for 69% of their oil imports. Europe, meanwhile, confronts the risk of liquefied natural gas supply disruptions, raising concerns about renewed stagflationary pressures. Emerging markets are particularly vulnerable to inflationary shocks stemming from volatile energy prices and disrupted trade routes. In navigating these turbulent economic waters, strategic financial planning becomes paramount. Gold has historically demonstrated resilience, exhibiting median gains of 6% following geopolitical crises, positioning it as a primary safe haven asset. U.S. Treasuries offer a degree of stability amidst market volatility. Exposure to the energy sector warrants consideration, as crude oil prices have historically rallied approximately 18% in the aftermath of such geopolitical events. Furthermore, defense sector exchange-traded funds are benefiting from a perceived supercycle in military expenditure. Adherence to fundamental investment principles, such as avoiding panic selling, employing dollar-cost averaging, and maintaining geographic diversification, remains crucial for wealth preservation. Domestically, the U.S. faces its own political considerations, including debates surrounding the War Powers Resolution and the looming 2026 midterm elections, which add another layer of complexity to the unfolding geopolitical landscape. The possibility of regime change in Iran emerges as a principal objective within the framework of ongoing military operations. This strategic consideration introduces a layer of profound complexity, carrying with it a spectrum of potential outcomes that extend far beyond the immediate cessation of hostilities. Operation Shield of Judah, launched on February 28, 2026, by the United States and Israel, targeted key Iranian infrastructure. Strikes were directed at nuclear facilities in Fordow, Natanz, and Isfahan, alongside the Iranian Ministry of Defense and the Office of the Supreme Leader. Military bases across Tehran, Qom, Karaj, Kermanshah, and Tabriz also sustained attacks. These actions followed the initial strikes of Operation Midnight Hammer in June 2025. Iran's response was immediate and significant, involving missile and drone barrages aimed at Israel and U.S. bases in Bahrain. Missiles were intercepted over Qatar, underscoring the regional reach of the conflict. The critical choke point of the Strait of Hormuz, through which approximately 20 million barrels of oil daily and 20% of global liquefied natural gas trade transit, faces a palpable threat of disruption. The economic repercussions are already unfolding. Oil prices have surpassed $72 per barrel, with Goldman Sachs forecasting a surge beyond $100 if the Strait of Hormuz were to be closed. Gold has reached record highs, trading above $5.200 per ounce. U.S. financial markets have reacted negatively, with the S&P 500 experiencing a decline and the VIX index rising above 20. Conversely, defense stocks have demonstrated robust performance, registering a 17% increase year-to-date. The pursuit of regime change represents one of 5 distinct scenarios shaping the geopolitical and economic landscape. The others include a limited strike followed by de-escalation, an extended air campaign, escalation into a wider regional conflict involving proxies such as Houthi and Iraqi militias, and ultimately a negotiated settlement facilitated by Omani mediation. The impact on Gulf states is varied. Saudi Arabia and the UAE have maintained a stance of non-assistance to the United States. Qatar, however, has engaged in missile interception, while Iraq has closed its airspace. For Asian economies, particularly China, India, Japan, and South Korea, which rely on the Strait of Hormuz for 69% of their oil imports, the implications are severe. European nations face the prospect of LNG supply disruptions and heightened risks of stagflation. Emerging markets are particularly vulnerable to inflationary shocks stemming from these global supply chain disturbances. In navigating these turbulent economic waters, a strategic approach to wealth preservation becomes paramount. Gold, historically a primary safe haven asset, has shown median gains of 6% following geopolitical crises. U.S. Treasuries offer a degree of stability. Exposure to the energy sector warrants consideration, as crude oil prices typically rally by an average of 18% in the aftermath of such events. Defense exchange-traded funds, or ETFs, are poised to benefit from an anticipated supercycle in military spending. Fundamental principles of sound financial management, including avoiding panic selling, employing dollar-cost averaging, and maintaining geographic diversification of assets, remain crucial. Domestically, the unfolding conflict introduces significant political considerations. The debate surrounding the war powers resolution is gaining prominence, coinciding with the approach of the 2026 midterm elections. These factors are interwoven with the broader economic and military strategies being deployed. The immediate aftermath of Operation Shield of Judah presents a complex geopolitical and economic landscape. A successful regime change, while potentially stabilizing the region in the long term, introduces significant immediate challenges. The dismantling of existing state structures, even authoritarian ones, often creates power vacuums. These vacuums can be filled by competing factions, leading to internal instability, civil unrest, or the rise of extremist groups. Reconstruction efforts following such a transition are arduous and resource-intensive. The Iranian economy, already strained by sanctions and conflict, would require substantial international aid and investment to rebuild infrastructure, re-establish functional governance, and foster economic recovery. The timeline for such a process is measured in years, if not decades, and is contingent on sustained international cooperation and a stable internal political environment. Conversely, an unsuccessful regime change effort carries its own set of repercussions. Protracted conflict, a weakened central government unable to assert control, or the emergence of a more hostile, fragmented entity could prolong regional instability. This scenario would likely exacerbate economic disruption, further impacting global supply chains and energy markets. The specter of ongoing or renewed conflict directly affects investor confidence, leading to capital flight from affected regions and increased volatility in global financial markets. The economic repercussions are far-reaching. The Strait of Hormuz, a critical artery for global energy trade, remains a focal point of concern. Its potential closure, even for a limited period, has already demonstrated its capacity to drive oil prices upwards, with Goldman Sachs forecasting prices exceeding $100 per barrel in such an event. This surge in energy costs ripples through every sector of the global economy, fueling inflation and potentially triggering stagflationary pressures, particularly in energy-dependent economies. Gold, traditionally a safe haven asset, has seen its value appreciate significantly, reaching record levels above $5.200 per ounce. This reflects a broader trend of investors seeking refuge from market volatility and geopolitical uncertainty. Equity markets, particularly in the United States, have experienced a downturn, with the S&P 500 declining and the VIX index rising above 20, signaling increased market anxiety. Conversely, defense sector stocks have shown robust performance, surging 17% year-to-date, indicative of anticipated increases in military spending. The impact on major global economies varies. Asia, heavily reliant on oil flows through the Strait of Hormuz, faces significant economic headwinds. China, India, Japan, and South Korea, which collectively account for 69% of oil passing through the strait, are particularly vulnerable to supply disruptions and price shocks. Europe, already grappling with energy challenges, faces the prospect of further LNG supply disruptions and heightened stagflation risks. Emerging markets are especially susceptible to inflationary shocks, which can destabilize their economies and impact social stability. The geopolitical dynamics among Gulf states are also evolving. Saudi Arabia and the UAE's refusal to provide direct assistance to the United States highlights a complex regional alignment. Qatar's interception of Iranian missiles underscores its delicate position, while Iraq's closure of its airspace demonstrates the challenges of navigating regional tensions. These actions underscore the intricate web of alliances and interests that shape the current conflict. Domestically, the U.S. faces political considerations, including debates surrounding the War Powers Resolution and the approaching 2026 midterm elections, adding a layer of political complexity to the ongoing military operations and their economic consequences. Understanding these interconnected factors is crucial for navigating the evolving financial landscape. The current geopolitical landscape, marked by Operation Shield of Judah, presents a complex challenge to global economic stability. Amidst active military operations and the specter of wider conflict, the pursuit of a negotiated settlement emerges as a critical pathway toward de-escalation and the mitigation of further economic disruption. In this context, the historical role of Oman as a neutral mediator in regional disputes warrants significant attention. Oman, situated strategically on the Arabian Peninsula, has cultivated a long-standing tradition of quiet diplomacy and non-alignment. This unique position has enabled the Sultanate to act as a trusted intermediary, facilitating dialogue between adversaries in past crises. Its consistent policy of maintaining open channels of communication with a diverse range of regional and global powers has built a reservoir of goodwill and established its credibility as a facilitator of peace. The current situation, following the joint U.S.-Israel strikes on February 28, 2026, and Iran's retaliatory actions, underscores the urgent need for such diplomatic initiatives. The potential disruption to the Strait of Hormuz, a vital artery for global energy trade through which approximately 20 million barrels of oil per day and 20% of global LNG trade flow, poses a significant threat to economic stability. The immediate market reactions reflect this gravity, with oil prices surging past $72 per barrel and Goldman Sachs warning of a potential rise to over $100 if the strait were to close. Similarly, gold has reached record highs above $5.200 per ounce, a testament to its traditional role as a safe haven asset during periods of heightened geopolitical uncertainty. In this environment, Oman's diplomatic efforts are not merely symbolic. They represent a tangible attempt to avert a more catastrophic escalation. Discussions are reportedly underway, leveraging Oman's established relationships and its reputation for discretion. The Sultanate's approach typically involves discreet consultations, shuttle diplomacy, and the careful nurturing of trust between parties. This meticulous process aims to identify common ground, explore potential de-escalation steps, and establish frameworks for dialogue that could eventually lead to a broader resolution. The success of such mediation efforts is, of course, contingent upon the willingness of all parties involved to engage constructively. However, the historical precedents of Omani mediation, particularly in facilitating communication between the United States and Iran prior to the 2015 Joint Comprehensive Plan of Action, demonstrate the Sultanate's capacity to achieve breakthroughs. These past successes provide a crucial foundation for current diplomatic endeavors. The analytical focus on Oman's role is not to suggest an immediate end to hostilities, but rather to highlight the mechanisms that are actively working towards de-escalation. The measured, analytical approach to understanding these diplomatic pathways is essential for navigating the economic implications of the ongoing conflict. By acknowledging and supporting these efforts, the potential for a negotiated settlement, however challenging, remains a viable scenario, with profound implications for global markets and the trajectory of the current geopolitical crisis. The measured pace of diplomacy, often unseen and unheralded, plays a crucial role in shaping the future economic landscape. The path to de-escalation and a lasting resolution in the current conflict hinges on the complex calculus of negotiated terms. Reaching a settlement requires navigating a landscape of deeply entrenched interests and historical grievances, demanding careful consideration of all parties involved. The immediate aftermath of Operation Shield of Judah, launched on February 28, 2026, presents a fragile window. Iran's retaliatory strikes, while met with successful interceptions over Qatar and Bahrain, underscore the potential for wider engagement. The critical choke point of the Strait of Hormuz, the conduit for 20 million barrels of oil and 20% of global LNG trade daily, remains under intense scrutiny. Its potential closure, a scenario flagged by Goldman Sachs with warnings of oil prices exceeding $100 per barrel, would trigger significant global economic repercussions. This geopolitical instability has already propelled gold to record highs above $5.200 per ounce and sent tremors through financial markets, with the S&P 500 experiencing a notable decline and the VIX index climbing above 20, even as defense stocks have seen year-to-date gains of 17%. Within this volatile environment, 5 distinct scenarios for conflict resolution are being analyzed. The first, a limited strike followed by a swift de-escalation, offers a pathway to immediate stabilization, though its feasibility depends on reciprocal restraint. A second, more extended air campaign risks drawing out the conflict and increasing the likelihood of unforeseen consequences. The third scenario, a widening regional war, could involve the entanglement of proxy forces such as the Houthi and Iraqi militias, amplifying the scale of the crisis. A fourth, more drastic outcome involves the potential for regime change within Iran, a scenario fraught with its own set of profound uncertainties and regional implications. The fifth and perhaps most crucial scenario is a negotiated settlement, with Omani mediation playing a pivotal role. This path requires concessions and a willingness to compromise from all sides. For Iran, potential terms might include guarantees against further strikes, assurances regarding its nuclear program, and a lifting of sanctions. For the United States and its allies, objectives would likely center on denuclearization, regional security, and the cessation of support for proxy groups. The impact on regional actors is already pronounced. Saudi Arabia and the UAE have maintained a stance of non-assistance to U.S. operations, a significant diplomatic development. Qatar's interception of Iranian missiles highlights its precarious position, while Iraq's closure of its airspace underscores the regional sensitivities. Across Asia, the stakes are particularly high. China, India, Japan, and South Korea collectively rely on 69% of the oil flowing through the Strait of Hormuz. Any disruption threatens their energy security and economic stability. Europe faces similar challenges, with potential LNG supply disruptions exacerbating inflationary pressures and the risk of stagflation. Emerging markets, already vulnerable, are exposed to significant inflationary shocks that could derail development. In this dynamic environment, proactive financial strategies are essential. Gold has historically demonstrated its value as a safe haven, with median gains of 6% following geopolitical crises. U.S. Treasuries offer a degree of stability amidst market volatility. Exposure to the energy sector, particularly as crude oil typically rallies 18% after such events, presents an opportunity. Furthermore, the current geopolitical climate heralds a defense spending supercycle, making defense ETFs a compelling consideration. Navigating these turbulent times requires a disciplined approach. Avoiding panic selling, embracing dollar-cost averaging, and maintaining geographic diversification are fundamental principles for wealth preservation and growth. The domestic political landscape in the United States also plays a significant role, with debates surrounding the War Powers Resolution and the impending 2026 midterm elections, adding another layer of complexity to the nation's foreign policy calculus. The successful negotiation of peace terms, therefore, is not merely a geopolitical imperative but an economic necessity. The strategic landscape surrounding Operation Shield of Judah presents a complex calculus for regional powers. Saudi Arabia and the United Arab Emirates, two of the most influential states in the Gulf, have notably opted against providing direct assistance to the United States in its military actions against Iran. This decision stems from a confluence of factors, reflecting a deliberate recalibration of their foreign policy objectives and risk assessments. For decades, Saudi Arabia and the UAE have navigated a delicate balance in their relationship with both Iran and the United States. While historically allied with Washington, their national interests have increasingly diverged from those of the U.S., particularly concerning the immediate threat posed by Iran. Riyadh and Abu Dhabi have prioritized their own economic development agendas, spearheaded by ambitious visions such as Saudi Vision 2030 and the UAE's own diversification strategies. These long-term goals are inherently vulnerable to regional instability and conflict. The economic implications of a full-scale confrontation involving the Strait of Hormuz, a vital artery for global energy trade, weigh heavily on these Gulf states. The passage of 20 million barrels of oil daily and 20% of global LNG trade through this choke point means that any disruption directly impacts their primary revenue streams and global economic standing. While the U.S. seeks to contain Iran's nuclear ambitions, Saudi Arabia and the UAE appear more focused on managing the immediate fallout and avoiding entanglement in a protracted conflict that could severely damage their economies and security. Furthermore, these nations have invested significantly in diplomatic channels, including overtures through Omani mediation to de-escalate tensions. Their refusal to actively support military strikes can be interpreted as a signal that they believe a diplomatic resolution, however challenging, remains the most viable path to long-term regional stability. This stance also allows them to maintain a degree of strategic autonomy, positioning themselves as potential mediators rather than direct belligerents. The implications of this non-involvement are profound. It suggests a regional order where traditional alliances are being re-evaluated through the lens of national interest and localized threat perception. For the United States, this refusal underscores the evolving dynamics of Middle Eastern geopolitics and the potential for diminished support in future regional security operations. It highlights the strategic challenge of maintaining influence when key regional partners prioritize their own immediate security and economic imperatives over collective defense pacts. The absence of direct Saudi and UAE military backing for Operation Shield of Judah therefore shapes the operational parameters and potential duration of the conflict, influencing the broader regional security architecture and the global economic ramifications that follow. Qatar finds itself navigating a particularly precarious geopolitical landscape. This small Gulf state, a crucial hub for international diplomacy and a significant energy producer, is caught between competing regional ambitions and its own international security commitments. The interception of Iranian missiles over its territory on February 28, 2026, during Operation Shield of Judah, serves as a stark illustration of this delicate balancing act. As United States and Israeli forces conducted targeted strikes against Iranian nuclear facilities and military infrastructure, Iran responded with retaliatory missile and drone salvos. While some of these projectiles were aimed at Israel, others targeted U.S. bases in Bahrain. It was during this exchange that Qatar's own airspace became a theater of operations, with its defense systems engaging Iranian threats. This action, while potentially safeguarding Qatari territory from collateral damage, also places the nation in a complex position relative to Iran, a powerful neighbor with whom it shares the vital North Field/South Pars gas field. The strategic importance of this region cannot be overstated. The Strait of Hormuz, a narrow choke point through which an estimated 20 million barrels of oil per day and 20% of global liquefied natural gas trade flow, faces unprecedented risk. The potential for its closure, even for a limited period, has immediate and profound economic consequences. Following the February 28 strikes, crude oil prices surged past $72 per barrel, with Goldman Sachs issuing a stark warning of potential prices exceeding $100 if the strait were to be disrupted. Concurrently, gold, a traditional safe haven asset, reached record highs, surpassing $5.200 per ounce as investors sought refuge from the escalating tensions. The ripple effects extend across global financial markets. United States equity markets experienced significant declines, with the S&P 500 showing a notable drop. The VIX, a measure of market volatility, climbed above 20, signaling heightened investor anxiety. In contrast, defense sector stocks demonstrated remarkable resilience, registering gains of 17% year-to-date, reflecting an anticipated increase in military spending. Qatar's response to the missile interceptions, while not explicitly aligning with the U.S.-led operation, demonstrates a commitment to its own security and the stability of its airspace. This contrasts with the positions of other regional players. Saudi Arabia and the United Arab Emirates, for instance, have reportedly declined to offer direct assistance to the United States in this operation. Meanwhile, Iraq has closed its airspace, further complicating transit routes and regional coordination. These geopolitical maneuvers have tangible implications for global energy supplies and economic stability. Asia, heavily reliant on oil flowing through the Strait of Hormuz, with China, India, Japan, and South Korea collectively accounting for 69% of these flows, faces significant disruption. Europe, dependent on LNG supplies, confronts the specter of stagflation as energy prices climb and supply chains are strained. Emerging markets, already vulnerable, are particularly susceptible to inflationary shocks. The situation underscores the interconnectedness of global security and economic well-being, highlighting how events in one region can have far-reaching consequences for markets and economies worldwide. The escalating conflict between the United States and Iran has prompted a significant geopolitical maneuver from Baghdad. On March 4, 2026, Iraq announced the complete closure of its airspace to all military and civilian aircraft, a move that signals a deliberate attempt to distance itself from the ongoing hostilities. This decision, made just days after the initiation of Operation Shield of Judah, underscores Iraq's strategic imperative to avoid becoming a direct participant in the widening regional confrontation. The closure affects a critical transit corridor. Iraq's airspace, situated strategically in the heart of the Middle East, has historically served as a vital artery for both commercial aviation and military logistics. Its closure now necessitates rerouting for numerous airlines and cargo operations, adding complexity and cost to regional supply chains. This decision is particularly impactful given the existing pressures on global transit routes, most notably the Strait of Hormuz, which is already experiencing heightened tensions. The potential disruption of this vital waterway, responsible for the transit of approximately 20 million barrels of oil daily and 20% of global liquefied natural gas trade, has already sent shockwaves through energy markets. Prior to Iraq's announcement, oil prices had surged past $72 per barrel, with analysts at Goldman Sachs warning of potential prices exceeding $100 if the strait were to be fully closed. The implications of Iraq's neutral stance extend beyond immediate logistical challenges. It highlights the delicate balancing act undertaken by regional powers navigating the complex geopolitical landscape. While the United States and Israel are engaged in direct military action against Iran, nations like Saudi Arabia and the United Arab Emirates have publicly stated their refusal to provide direct assistance to the U.S. operations. Qatar, meanwhile, found itself in the position of intercepting Iranian missile and drone salvos aimed at Israel and U.S. bases in Bahrain, demonstrating the immediate ripple effects of the conflict. Iraq's decision to close its airspace can be interpreted as a deliberate measure to insulate itself from direct involvement, a move that, while potentially preserving its own stability, adds another layer of complexity to regional military and economic strategies. The economic ramifications are already being felt globally. Financial markets are exhibiting significant volatility. Gold has reached record highs, surpassing $5.200 per ounce, as investors flock to traditional safe haven assets. In the United States, equity markets have seen declines, with the S&P 500 experiencing a downturn and the VIX, a measure of market volatility, rising above 20. Conversely, defense stocks have seen substantial gains, reflecting increased military spending and the anticipation of prolonged geopolitical instability. This surge in defense sector performance, with a year-to-date gain of 17%, underscores the economic beneficiaries of escalating global tensions. The current situation is one of several potential scenarios unfolding. The initial strikes of Operation Shield of Judah following the June 2025 Operation Midnight Hammer could represent a limited engagement intended to de-escalate. However, the possibility of an extended air campaign or a broader regional war, drawing in proxy forces like Houthi militants and Iraqi militias, remains a significant concern. Other scenarios under consideration include the potential for regime change in Iran or a negotiated settlement, with Oman reportedly playing a mediating role. Each of these pathways carries distinct economic consequences, impacting everything from energy prices and supply chains to global inflation and investment strategies. The decisions made by nations like Iraq to close their airspace or maintain a neutral stance are critical indicators of the evolving geopolitical dynamics and their profound impact on the global economy. The closure of Iraqi airspace, imposed on March 3, 2026, reverberates far beyond the immediate conflict zone. This decision, a direct consequence of Operation Shield of Judah and the ensuing regional tensions, has significant ramifications for air travel and cargo throughout the Middle East. Baghdad's move effectively grounds all commercial and most military flights over its territory, forcing airlines to reroute their operations. This rerouting translates into longer flight times, increased fuel consumption, and ultimately higher operational costs for carriers. For passengers, this means extended journeys and potential fare increases. The impact on cargo is even more pronounced. Iraq serves as a critical transit hub for goods moving between Europe, Asia, and Africa. The closure disrupts established supply chains, delaying the delivery of everything from manufactured goods to essential medical supplies. Businesses relying on timely deliveries face production slowdowns and increased inventory costs. The ripple effect extends to the broader flow of goods and services. Disruptions to air cargo capacity can lead to shortages of specific items, pushing their prices higher. This adds another layer of inflationary pressure to an already volatile global economic landscape. The rerouting of flights also impacts air traffic control services and the associated revenue streams for countries that previously facilitated this transit. The closure, therefore, represents a significant, albeit indirect, economic shock to the region's connectivity. The Strait of Hormuz, a vital artery for global energy supplies, remains a focal point of concern. Through this narrow waterway, approximately 20 million barrels of oil per day and 20% of the world's liquefied natural gas trade pass. Any sustained disruption here would trigger significant price spikes. Goldman Sachs has already warned of oil prices exceeding $100 per barrel should the strait become impassable. This potential supply shock has direct implications for energy-dependent economies and manufacturing sectors worldwide. The financial markets are reflecting these geopolitical anxieties. Gold, traditionally a safe haven asset, has reached record highs, surpassing $5.200 per ounce. This surge indicates investor demand for tangible assets amidst uncertainty. U.S. equity markets have experienced a downturn, with the S&P 500 declining. The VIX, a measure of market volatility, has risen above 20, signaling increased investor apprehension. Conversely, defense stocks have seen a substantial uptick, gaining 17% year-to-date, a clear indicator of anticipated increased military spending. The implications for regional allies and partners are also becoming clearer. Saudi Arabia and the UAE have signaled a refusal to directly assist the United States in its military operations, highlighting a complex geopolitical landscape. Qatar, however, played a crucial role in intercepting Iranian missiles over its territory, demonstrating its strategic position and its own security concerns. These differing responses underscore the nuanced alliances and interests at play in the ongoing conflict. The economic fallout is not confined to the Middle East. Asia, heavily reliant on oil flows through the Strait of Hormuz, faces significant challenges. China, India, Japan, and South Korea collectively depend on 69% of the oil transiting this waterway. Any disruption will directly impact their energy security and industrial output. Europe, already grappling with energy price volatility, faces the risk of further LNG supply disruptions, potentially exacerbating stagflationary pressures. Emerging markets are particularly vulnerable, as they often lack the financial buffers to withstand such inflationary shocks, potentially leading to significant social and economic instability. The Strait of Hormuz, a narrow maritime choke point, serves as a critical artery for global energy markets. It is here that a significant portion of the world's oil and liquefied natural gas transits daily. For the economic powerhouses of Asia, this waterway represents an indispensable lifeline. China, India, Japan, and South Korea collectively depend on a staggering 69% of the oil that flows through the Strait of Hormuz. This profound reliance underscores their acute vulnerability to any disruption in this vital corridor. The figures are stark. Approximately 20 million barrels of oil per day and a fifth of global LNG trade traverse these waters. The current geopolitical climate, marked by Operation Shield of Judah and Iran's retaliatory actions, places this critical supply route under considerable strain. The potential for conflict to directly impact shipping lanes is a tangible risk, with significant consequences for the energy security of these major Asian economies. The interconnectedness of the global economy means that instability in the Persian Gulf reverberates far beyond the immediate region, directly impacting the economic stability and growth prospects of nations heavily reliant on these energy imports. This dependence is not merely an abstract statistic. It represents the fuel that powers their industries, heats their homes, and underpins their very economic models. Any threat to this flow carries immediate and substantial economic ramifications. Operation Shield of Judah, launched on February 28, 2026, has sent significant shockwaves across global markets, with particular concern for the economic stability of major Asian economies. These nations, deeply integrated into the global energy supply chain, are exceptionally vulnerable to disruptions emanating from the Strait of Hormuz. China, India, Japan, and South Korea collectively depend on approximately 69% of the oil flowing through this critical choke point. A sustained closure or even significant slowdown in transit would directly impact their manufacturing sectors, which are the engines of their respective economies. For China, any interruption to its energy imports threatens to exacerbate existing slowdowns, potentially impacting its ambitious manufacturing output targets for 2026. Data from early 2026 indicated that China was importing over 11 million barrels of oil per day, a substantial portion of which transits the Strait. India, heavily reliant on Middle Eastern crude, faces a dual threat of reduced supply and soaring import costs. With inflation already a concern in early 2026, a surge in oil prices, which saw crude surpass $72 per barrel following the initial strikes, would disproportionately affect its large population and industrial base. Goldman Sachs' warning of oil exceeding $100 per barrel in a Strait closure scenario is a stark indicator of the potential inflationary pressures. Japan and South Korea, both advanced economies with significant manufacturing export bases, are similarly exposed. Their reliance on imported energy fuels their industrial machinery and transportation networks. Disruptions translate directly into higher production costs, impacting their competitiveness in global markets and potentially leading to reduced export volumes. The immediate aftermath of Operation Shield of Judah saw a significant spike in volatility across Asian markets, reflecting this underlying vulnerability. Beyond direct energy supply, the broader impact of geopolitical instability on investor confidence cannot be overstated. Asian economies, which have benefited immensely from global trade and investment flows, could see a significant retraction in foreign direct investment and portfolio flows as capital seeks safer havens. This could dampen overall economic growth prospects, reversing some of the gains seen in the preceding years. The manufacturing sector in particular is a bellwether for this economic stress. Increased energy costs directly translate into higher operational expenses for factories. This could lead to phased production cuts, delayed expansion plans, and ultimately, a slowdown in job creation. Furthermore, the inflationary pressures stemming from higher energy prices can erode consumer purchasing power, further dampening demand for manufactured goods. The ripple effect extends to the financial markets within Asia. Stock exchanges, which are sensitive to global economic sentiment, are likely to experience increased volatility. While some sectors, such as defense, may see short-term gains due to increased military spending globally, the broader impact on industrial and consumer-facing companies is expected to be negative. The interconnectedness of the global economy means that economic distress in one major region inevitably transmits to others. The Asian economies, with their significant role in global supply chains and their substantial energy import needs, stand at the forefront of this potential economic recalibration. The coming months will be critical in determining the extent to which these economies can absorb the shockwaves and adapt to a reshaped global energy and trade landscape. Europe's energy security, particularly its reliance on liquefied natural gas, presents a critical vulnerability in the current geopolitical landscape. The continent imports a significant portion of its LNG, with a substantial volume transiting vital maritime choke points. The Strait of Hormuz, a narrow waterway at the Persian Gulf's entrance, is a linchpin in global energy transport. This passage is responsible for facilitating the movement of approximately 20 million barrels of oil daily, and crucially for Europe, it handles about 20% of the world's LNG trade. The ongoing military operations, initiated on February 28, 2026, under Operation Shield of Judah, have introduced a heightened risk of disruption to this critical artery. Iran's retaliatory actions, including missile and drone salvos, have directly impacted regional stability. While missiles were intercepted over Qatar, the threat to maritime traffic through the Strait of Hormuz remains a significant concern. Any sustained instability or blockage in this waterway could have immediate and severe consequences for Europe's energy imports. This dependence on LNG, often sourced from regions whose supply routes pass through or near the strait, places European economies on the front lines of potential energy shocks. The implications extend beyond mere supply shortages. They encompass drastic price volatility and the looming specter of stagflation. As global energy markets react to the heightened tensions, benchmark crude oil prices have already surpassed $72 per barrel. Analysts at Goldman Sachs have issued stark warnings, indicating that a closure of the strait could propel oil prices to over $100 per barrel. This volatility directly impacts the cost of LNG. For European nations that have transitioned away from pipeline gas, particularly from Russia, LNG has become a cornerstone of their energy strategy. However, securing these shipments through volatile shipping lanes introduces a new layer of risk. If the flow of LNG through the Strait of Hormuz is significantly curtailed or halted, Europe would face a severe deficit. This deficit would necessitate sourcing alternative, likely more expensive, supplies or facing the prospect of rationing and industrial slowdowns. The economic ramifications are profound. An escalation of energy costs fuels inflation across all sectors, from transportation to manufacturing. Coupled with a potential slowdown in economic activity due to energy scarcity, this creates the conditions for stagflation, a pernicious economic environment characterized by high inflation and stagnant growth. This scenario poses a substantial challenge to economic policymakers across the continent, demanding careful navigation to mitigate both price pressures and recessionary risks. The delicate balance of energy procurement, once considered a stable element of economic planning, now stands as a significant point of geopolitical and economic exposure. The economic landscape of Europe now faces a significant and concerning specter: stagflation. This perilous combination of stagnant economic growth and persistent high inflation presents a formidable challenge. The primary drivers of this inflationary pressure are readily identifiable. Soaring energy prices, a direct consequence of the escalating geopolitical tensions and the potential disruption to vital supply routes, are a major contributor. Concurrently, ongoing supply chain disruptions exacerbated by the conflict continue to impede the flow of goods and materials, further driving up costs across the continent. Since February 28, 2026, when Operation Shield of Judah commenced with joint U.S. and Israeli strikes against Iran's nuclear facilities and military infrastructure, the ripple effects on global energy markets have been profound. The Strait of Hormuz, a critical artery for global energy transit, through which an estimated 20 million barrels of oil and 20% of global liquefied natural gas trade pass daily, now stands as a focal point of potential disruption. This vulnerability has already sent shockwaves through commodity markets. Crude oil prices have surged past $72 per barrel, with analysts at Goldman Sachs issuing stark warnings of prices potentially exceeding $100 per barrel should the Strait face a sustained closure. This inflationary environment has also triggered a flight to traditional safe haven assets. Gold has reached record levels, trading above $5.200 per ounce, as investors seek to preserve capital amidst the uncertainty. In contrast, U.S. equity markets have experienced significant downturns. The S&P 500 has seen a notable decline, and the VIX, a key measure of market volatility, has climbed above 20, signaling heightened investor anxiety. Conversely, the defense sector has demonstrated remarkable resilience and growth, with defense stocks appreciating by an average of 17% year-to-date, reflecting increased global military spending. The implications of this conflict extend far beyond immediate market reactions. The potential for extended military operations, wider regional escalation involving proxy forces, or even a protracted air campaign introduces a spectrum of economic outcomes. The refusal of key Gulf states, notably Saudi Arabia and the UAE, to provide direct assistance to the United States, coupled with Qatar's interception of Iranian missiles and Iraq's closure of its airspace, highlights the complex geopolitical realignments at play. Asia, heavily reliant on energy flows through the Strait of Hormuz, with China, India, Japan, and South Korea collectively accounting for 69% of these flows, faces substantial economic risk. Disruptions to LNG supplies are a particular concern for Europe, magnifying the already present threat of stagflation. Emerging markets are also vulnerable to significant inflationary shocks, potentially destabilizing their economies. In navigating this complex economic terrain, a prudent approach to wealth management becomes paramount. Gold stands as a primary safe haven asset, historically demonstrating median gains of approximately 6% in the aftermath of geopolitical crises. U.S. Treasuries offer a degree of stability in volatile times. Furthermore, strategic exposure to the energy sector, which typically rallies by an average of 18% following such events, and defense sector exchange-traded funds benefiting from a sustained increase in military expenditure warrant consideration. Core principles of avoiding panic-driven selling, embracing dollar-cost averaging, and maintaining geographic diversification of assets remain fundamental strategies for resilience. The domestic political landscape in the United States, including ongoing debates surrounding the War Powers Resolution and the approaching 2026 midterm elections, adds another layer of complexity to the economic outlook. Emerging markets, by their very nature, possess a heightened vulnerability to external economic shocks. This susceptibility is amplified when global commodity prices, particularly energy, experience significant upward pressure. The ongoing geopolitical turmoil, stemming from Operation Shield of Judah, directly translates into these inflationary pressures for economies that rely heavily on imported resources. The immediate aftermath of the February 28, 2026 strike saw a swift and predictable reaction in global energy markets. Brent crude oil prices, which had already been influenced by the preceding Operation Midnight Hammer in June 2025, surged past $72 per barrel. This rise is not merely a statistical blip, it represents a tangible increase in the cost of doing business and living for a vast portion of the world. For nations heavily dependent on oil imports, this price escalation directly impacts transportation costs, manufacturing expenses, and ultimately the price of everyday goods for consumers. The potential for a complete disruption of the Strait of Hormuz, a critical artery for global energy trade, looms large. This narrow waterway, through which approximately 20 million barrels of oil and 20% of global liquefied natural gas trade flows daily, is a linchpin of the international energy supply chain. Goldman Sachs' cautionary projection of oil prices exceeding $100 per barrel in the event of a strait closure underscores the gravity of this risk. Such a scenario would not only exacerbate existing inflationary pressures but could trigger a broader economic crisis, disproportionately affecting those emerging economies with less robust foreign exchange reserves and limited domestic energy production. This inflationary shock extends beyond crude oil. The prices of other essential commodities, from agricultural products to industrial metals, are also subject to the volatility introduced by geopolitical instability. Supply chains, already strained by previous global events, face new and significant disruptions. For emerging markets, this translates into higher import bills, wider trade deficits, and a depletion of foreign currency reserves needed to stabilize their own currencies. Consider the impact on Asia, a continent where nations like China, India, Japan, and South Korea collectively depend on a staggering 69% of the oil flowing through the Strait of Hormuz. Any sustained interruption would necessitate a rapid and costly recalcitrant of their energy procurement strategies, potentially leading to significant domestic inflation and slower economic growth. Similarly, Europe, already grappling with post-pandemic economic challenges, faces the dual threat of LNG supply disruptions and the specter of stagflation, a pernicious combination of high inflation and stagnant economic output. In this environment, emerging markets find themselves at the sharp end of imported inflation. Their currencies, often more volatile than those of developed nations, are further pressured by capital flight as investors seek perceived safe havens. This currency depreciation only serves to magnify the cost of imported goods, creating a vicious cycle. The ability of these economies to absorb such shocks is limited, making them particularly susceptible to cascading economic distress. The challenge lies not just in managing the immediate price increases, but in navigating the potential for prolonged economic instability that such imported inflation can precipitate. The economic reverberations of Operation Shield of Judah extend far beyond the immediate conflict zone, posing significant challenges to emerging markets already navigating delicate financial landscapes. Global economic shocks such as the current military engagement can act as powerful catalysts, exacerbating pre-existing fragilities and potentially triggering a cascade of negative consequences. Emerging market economies often exhibit a greater susceptibility to external shocks due to factors like higher levels of dollar-denominated debt, lower foreign exchange reserves, and more volatile domestic capital flows. When global uncertainty spikes, as it has with the strikes against Iran, capital tends to flee these more vulnerable economies in search of perceived safety. This outflow of capital can lead to significant currency depreciation. A weaker currency, in turn, inflates the cost of imported goods, including essential commodities like food and energy, thereby fueling domestic inflation. This inflationary pressure, coupled with a depreciating currency, can place immense strain on a nation's ability to service its debt obligations, particularly those denominated in foreign currencies. The cost of borrowing increases, and the real value of assets diminishes. This creates a vicious cycle, where initial economic shocks amplify existing weaknesses, potentially leading to a full-blown debt crisis. Consider the implications for nations heavily reliant on imported energy or food. A disruption to global supply chains or a sharp rise in commodity prices, directly impacts their balance of payments and household budgets. For instance, the potential closure of the Strait of Hormuz, a critical artery for 20 million barrels of oil and 20% of global LNG trade daily, has already prompted warnings of oil prices exceeding $100 per barrel. For emerging economies, this translates into a higher import bill, further straining foreign exchange reserves and exacerbating inflationary pressures. Furthermore, the global surge in safe haven assets, such as gold, which has already surpassed $5.200 per ounce, signals a broader flight from risk. While beneficial for holders of these assets, it underscores the deleveraging occurring in riskier segments of the global financial system, which often includes emerging market equities and bonds. The interconnectedness of the global financial system means that a crisis in one region can quickly transmit to others. A debt crisis in an emerging market can lead to a contraction in global trade, reduced investment flows, and even contagion effects across other developing economies. The current geopolitical tensions, therefore, are not merely a regional concern, but a systemic risk that demands careful monitoring and strategic financial planning. The ability of emerging markets to weather these storms will depend on their pre-existing economic resilience, their policy responses, and the evolving nature of the conflict itself. Gold's historical performance during periods of geopolitical uncertainty offers a crucial benchmark. Analysis of past crises reveals a consistent trend. Gold often serves as a primary safe haven asset. Median gains recorded following significant geopolitical events average approximately 6%. This segment delves into the data, illustrating gold's resilience and its tendency to appreciate when global stability is threatened. The current geopolitical landscape, marked by Operation Shield of Judah, presents a complex challenge. The joint U.S.-Israeli strikes on February 28, 2026, targeting Iran's nuclear facilities and key strategic locations, represent a significant escalation. These actions follow the June 2025 Operation Midnight Hammer, indicating a sustained period of heightened tension. Iran's retaliatory measures, including missile and drone attacks on Israel and U.S. bases in Bahrain, with interceptions over Qatar, underscore the immediate and volatile nature of the conflict. The Strait of Hormuz, a critical artery for global energy supply, faces potential disruption. This waterway, through which approximately 20 million barrels of oil and 20% of global liquefied natural gas trade flow daily, is central to concerns about energy security. The immediate aftermath saw oil prices surge past $72 per barrel, with Goldman Sachs projecting prices exceeding $100 should the strait be closed. Simultaneously, gold reached record highs, surpassing $5,200 per ounce, reflecting its traditional role as a hedge against instability. U.S. financial markets have reacted with volatility. The S&P 500 experienced a decline, and the VIX index rose above 20, signaling increased market apprehension. Conversely, defense sector stocks have seen substantial gains, rising 17% year-to-date, indicative of anticipated increases in military spending. The economic implications extend far beyond the immediate conflict zone. Asia, heavily reliant on oil flows through the Strait of Hormuz, faces significant risks. China, India, Japan, and South Korea, which depend on these flows for 69% of their oil imports, are particularly vulnerable. Europe confronts potential liquefied natural gas supply disruptions, raising the specter of stagflation. Emerging markets, already grappling with economic pressures, face additional inflationary shocks. The Gulf states present a complex regional dynamic. Saudi Arabia and the United Arab Emirates have reportedly declined to offer assistance to the United States, while Qatar has been involved in intercepting Iranian missiles. Iraq's decision to close its airspace further illustrates the fragmented regional response. Understanding these historical patterns and current dynamics is essential for informed financial decision-making. Gold's consistent performance as a safe haven. The strategic integration of gold into an investment portfolio serves as a critical component for capital preservation and a robust hedge against inflationary pressures, particularly in the current geopolitical climate. Following the events of February 28, 2026, with the commencement of Operation Shield of Judah, gold has demonstrated its inherent value as a safe haven asset. The precious metal reached record highs exceeding $5.200 per ounce, a significant indicator of investor flight to perceived stability amidst escalating global tensions. Historical data suggests that gold typically experiences median gains of approximately 6% in the aftermath of significant geopolitical crises. This performance underscores its role in buffering portfolio value against the volatility inherent in such events. Therefore, a strategic allocation, though specific proportions will vary based on individual risk tolerance and financial objectives, is a prudent consideration. It is not about speculative trading, but about long-term resilience. Beyond gold, other asset classes warrant consideration for portfolio diversification. U.S. Treasuries, while offering lower potential returns, provide a bedrock of stability, particularly during periods of market uncertainty. The anticipated surge in defense spending, driven by the ongoing conflict and the broader geopolitical realignment, presents a compelling case for exposure to the energy sector and defense-related investments. Crude oil prices have historically rallied, often by as much as 18% following such geopolitical shocks, and defense exchange-traded funds, or ETFs, are poised to benefit from increased military expenditures, potentially entering a supercycle of growth. The principles of sound investment strategy remain paramount. Avoiding panic selling is crucial. Emotional decisions during market downturns can lock in losses. Instead, a disciplined approach, such as dollar-cost averaging, allows for the systematic accumulation of assets at varying price points, thereby mitigating the risk of investing at a market peak. Geographic diversification, spreading investments across different regions and economies, further insulates a portfolio from localized shocks. The economic ramifications of Operation Shield of Judah and the preceding Operation Midnight Hammer are far-reaching. The potential disruption to the Strait of Hormuz, a vital artery for global energy trade, carries significant implications. With 20 million barrels of oil and 20% of global LNG passing through this choke point daily, any interruption directly impacts supply chains and fuels inflationary pressures. Goldman Sachs, warning of oil prices exceeding $100 per barrel in the event of a Strait closure, highlights the fragility of the current energy market. Asia, heavily reliant on these oil flows, with China, India, Japan, and South Korea collectively depending on 69% of the oil transiting Hormuz, faces considerable economic headwinds. Europe, already grappling with inflationary risks, confronts further supply disruptions for liquefied natural gas, potentially exacerbating stagflationary trends. Emerging markets are particularly vulnerable to these inflationary shocks, which can destabilize economies and erode purchasing power. The domestic political landscape within the United States also plays a role. The ongoing debates surrounding the War Powers Resolution and the proximity of the 2026 midterm elections introduce an additional layer of complexity to the economic outlook. These factors underscore the interconnectedness of geopolitical events, economic stability, and financial market performance. A strategic approach to portfolio construction, emphasizing assets that historically perform well during periods of uncertainty, is therefore not merely advisable but essential for navigating the challenges ahead. In times of heightened geopolitical tension, discerning investors seek assets that offer a degree of predictability and stability. Among these, United States Treasuries have historically served as a cornerstone of capital preservation. Their performance during periods of market volatility is a testament to their role as a reliable anchor in a turbulent financial sea. Following the coordinated strikes of Operation Shield of Judah on February 28, 2026, targeting key Iranian nuclear and defense infrastructure, global markets experienced immediate reactions. The S&P 500 saw a notable decline, and the VIX index, a measure of expected market volatility, rose above 20. This environment of uncertainty underscores the appeal of assets perceived as safe havens. U.S. Treasuries, backed by the full faith and credit of the United States government, present a compelling case for portfolio stability. Their low correlation with equities, particularly during periods of distress, makes them an effective diversifier. Historically, in the aftermath of significant geopolitical events, demand for these instruments tends to increase as investors prioritize the security of principal over higher potential returns. Consider the data. When global conflicts escalate, capital often flows into U.S. government debt. This flight to safety is driven by the perception of treasuries as a low-risk asset, offering a predictable income stream and the return of principal at maturity. While other asset classes may experience sharp downturns, the intrinsic value and liquidity of U.S. Treasuries remain largely intact, providing a vital buffer against widespread market contagion. The current situation, with the ongoing conflict stemming from Operation Shield of Judah, presents a complex economic backdrop. The potential disruption to the Strait of Hormuz, a critical artery for global oil and LNG trade, has already sent crude oil prices soaring past $72 per barrel. Gold has reached record highs above $5.200 per ounce. In this context, the steady, albeit lower, returns offered by U.S. Treasuries become particularly attractive for wealth preservation. For investors focused on safeguarding capital, U.S. Treasuries offer a proven track record. Their role in a diversified portfolio is not one of aggressive growth, but rather of resilience. They act as a stabilizing force, mitigating the impact of sharp market declines and providing a secure foundation upon which other, more growth-oriented investments can be built. The measured approach of holding U.S. Treasuries allows for a more rational response to market fluctuations, avoiding the detrimental effects of panic selling. This strategic allocation ensures that a portion of an investment portfolio remains insulated from the most severe shocks, a critical consideration for high-net-worth individuals navigating the complexities of global economic instability. Operation Shield of Judah, launched on February 28, 2026, marks a significant escalation in the geopolitical landscape, with profound implications for global markets. The joint U.S.-Israeli strikes, targeting key Iranian nuclear and military infrastructure, follow the earlier Operation Midnight Hammer in June 2025. Iran's retaliatory actions, including missile and drone salvos against Israel and U.S. bases in Bahrain, with intercepts occurring over Qatar, underscore the immediate volatility. Central to this unfolding crisis is the Strait of Hormuz, a critical choke point for global energy and LNG trade. An estimated 20 million barrels of crude oil and 20% of global liquefied natural gas pass through this waterway daily. The potential for its disruption has already sent crude oil prices surging past $72 per barrel. Goldman Sachs has issued a stark warning. A full closure of the strait could propel oil prices to over $100 per barrel. This heightened uncertainty has also driven gold to record highs, exceeding $5.200 per ounce. In response to these developments, U.S. markets have seen a downturn, with the S&P 500 experiencing a decline and the VIX index rising above 20. Conversely, defense stocks have demonstrated considerable resilience, posting gains of 17% year-to-date. Within this dynamic environment, exposure to the energy sector presents a notable opportunity. Historical data indicates that crude oil prices typically exhibit a rally of approximately. The financial landscape, inherently sensitive to geopolitical shifts, is currently navigating a period of profound uncertainty. Following the coordinated strikes under Operation Shield of Judah on February 28, 2026, targeting key Iranian nuclear and military installations, markets have reacted with volatility. This operation, a successor to the June 2025 Midnight Hammer strikes, has elevated tensions, prompting significant economic adjustments. Iran's response, characterized by missile and drone salvos against Israel and U.S. bases in Bahrain, with interceptions reported over Qatar, has directly impacted critical global trade routes. The Strait of Hormuz, a vital artery for approximately 20 million barrels of oil daily and 20% of global liquefied natural gas trade, now faces the specter of disruption. This vulnerability has already propelled oil prices beyond $72 per barrel, with analyses from Goldman Sachs suggesting a potential surge to over $100 should the strait become impassable. Simultaneously, gold has reached historic highs, trading above $5.200 per ounce, reflecting its traditional role as a safe haven asset during times of geopolitical stress. U.S. equity markets have experienced a downturn, with the S&P 500 registering declines. The VIX, a measure of market volatility, has risen above 20, indicating heightened investor apprehension. Conversely, the defense sector has demonstrated resilience and growth, with defense stocks appreciating by 17% year-to-date, a trend often associated with increased military spending. In such an environment, disciplined investment principles become paramount. The instinct to panic sell during market downturns is a common yet often detrimental reaction. Historically, markets have demonstrated a capacity for recovery, and emotional decisions made under duress can lead to significant long-term losses. A more strategic approach involves maintaining a long-term perspective and avoiding impulsive actions. One such strategy is dollar-cost averaging. This method involves investing a fixed amount of money at regular intervals, regardless of market conditions. By purchasing more shares when prices are low and fewer when prices are high, dollar-cost averaging can help to reduce the average cost per share over time and mitigate the risk of investing a large sum at a market peak. This systematic approach fosters discipline and removes the guesswork from market timing. Furthermore, geographic diversification remains a cornerstone of sound investment strategy, particularly in an era of localized geopolitical events with global ripple effects. The current situation highlights the interconnectedness of regional conflicts and their impact on international markets. While the United States and Israel are at the forefront of Operation Shield of Judah, the economic consequences extend far beyond. Asian economies, heavily reliant on oil flows through the Strait of Hormuz, with China, India, Japan, and South Korea collectively depending on 69% of these flows, face significant import cost increases and potential supply chain disruptions. European nations confront similar risks, with potential LNG supply interruptions exacerbating inflationary pressures and increasing the likelihood of stagflation. Emerging markets are particularly vulnerable to inflationary shocks, which can erode purchasing power and destabilize economies. Therefore, a diversified portfolio that spans different asset classes and geographic regions can help to buffer against localized shocks. While energy sector exposure, given the typical rally of crude oil by approximately 18% following such events, and defense sector ETFs, benefiting from increased military expenditure present opportunities, they must be considered within a broader, well-balanced strategy. U.S. Treasuries offer a measure of stability, and gold, historically a reliable hedge against geopolitical crises, has shown median gains of around 6% after such events. The key is to avoid concentrating risk and to ensure that investments are aligned with a long-term financial plan, rather than reacting to short-term market fluctuations. The domestic political landscape within the United States is also experiencing significant shifts, intricately tied to the unfolding conflict. The War Powers Resolution of 1973, a legislative check on presidential authority to commit armed forces abroad without congressional consent, is once again a focal point of debate. As military operations continue, questions arise regarding the scope of executive action and the necessity of congressional consultation. The current administration's strategic decisions, particularly those involving sustained military engagement, are under intense scrutiny, with lawmakers on both sides of the aisle weighing in on the balance of power. This domestic political calculus is further complicated by the approaching 2026 midterm elections. Historically, periods of international conflict can have a profound impact on electoral outcomes. The public's perception of the administration's handling of Operation Shield of Judah and its broader implications for national security and economic stability will undoubtedly feature prominently in campaign narratives. The economic fallout, including fluctuating energy prices and market volatility, will likely become a key issue for voters. The performance of incumbent parties in managing these challenges will be a critical factor in determining electoral success. The defense sector, already experiencing a surge in value, may see further investment in political support, reflecting a national security-first approach that often resonates during uncertain times. Conversely, concerns about inflationary pressures and the cost of prolonged military engagement could fuel opposition sentiment. The interplay between foreign policy decisions and domestic political consequences creates a dynamic and complex environment, where the long-term implications of Operation Shield of Judah extend beyond the geopolitical arena and into the very heart of American governance and electoral politics. The administration's ability to navigate these domestic pressures while managing the international crisis will be a defining characteristic of its tenure.